Hi guys, welcome to Cashcraft Finance, and you better buckle up because the entire car market is fucked. For the first time ever in history, the average price of a new car is about to surpass $50,000. Auto loan payments are exceeding $745 a month. And with interest rates near their all-time highs, Americans are now officially beginning to fall behind in their payments. This is why it's so important that we break down exactly why cars have become America's #1 wealth killer, why used car prices are spiking again, and then what the data says is most likely going to happen over the next year. Because there are 3 points that you need to be made aware of if you want to save a ton of money. Although before we start, if you appreciate videos like this or even find them helpful, it would mean the world to me if you gave the like button a little gassed or subscribed if you haven't done that already. So first of all, we got to talk about the boogeyman for anybody who owns a vehicle, and that would be appreciation. Like, here's the thing, for the longest time, when you think about car prices, you'd imagine a chart like this. In a normal market, a new car is expected to lose anywhere from 9 to 18% the moment you drive it off the lot. And then from there, prices continue to fall by an additional 10 to 20% a year. Until after 5 years of ownership, you're left with about 40% of the price that you paid. However, these last few years have completely messed that up. Because of a shortage of auto manufacturing, a limited supply of parts, record low interest rates, and a surge of demand, used car prices began to defy the laws of gravity by going up in price. For instance, in 2021, used car prices were 40% higher than the year prior. Meaning back then you could literally go and buy a car, drive it around for free, and then sell it a few years later for a massive profit. Not to mention, throughout 2022, it wasn't unusual for buyers to pay over sticker price just to get the car from the dealership, and at the height of the shortage, the average vehicle was priced 9.9% above MSRP, all thanks to high demand and limited supply. Yet despite nearly every other pandemic shortage eventually coming back down to reality, car prices never really fell that much. Like as of now, new cars are still $12,000 more expensive than they were. A few years ago, the typical family would have to spend 70 to 80% of their entire year's pay just to buy a vehicle at today's prices, which is double from what it used to be in 1990. And all of this simply means that car prices are outpacing incomes. More buyers than ever have payments that exceed $1,000 a month. And we have a new category that's absolutely out of control, and that would be skyrocketing debt. See, when buyers purchase a car, the vast majority of them are financed. In fact, 85% of new car purchases are bought with debt, along with 55% of used car purchases. And what makes this so unique is that, unlike real estate, auto loans are not subject to strict underwriting requirements, allowing pretty much anyone to get financed for a new vehicle if they really want to drive off in a new car. You know, I mentioned this before, but the situation got so bad that in late 2021, Jalopnik ran a story about just how easy it was to get approved for a loan, and just how predatory lenders had become, calling it a true wild, wild west in a poorly regulated wasteland. In this case, their investigation found that borrowers in every credit score category were given loans with APRs that ranged from 0% to more than 25%. Or in other words, buyers with great credit scores were being funneled into high interest rate loans with interest rates that were more than double the average, since they were just desperate to get into a new car. On top of that, 25 to 50% of loans were given to customers who might not have been able to afford them. And to make matters worse, lenders rarely verified income and employment to borrowers to confirm they had the sufficient income to repay the loan. Of the loans consumer reports looked at, these verifications happened just 4% of the time. This has now resulted in 5% of all auto loans in the United States being more than 90 days behind on their payments. Subprime loans have hit a record high delinquency rate, and 39% of all buyers are underwater on their purchase, meaning they owe more in the car than what the car is actually worth. How is this allowed to happen? Well, I'll let you in on a little secret. Contrary to popular belief, an Iowa law review found that over the last 10 years, car dealerships have begun making more profits from the financing of cars rather than from the cars themselves, meaning they have a direct financial interest in you taking out as big of a loan as you possibly can, because that's actually how they make their money, not from selling cars. I'd like to give you an idea just how big this problem has become. U.S. auto loan balances have increased to $1.64 trillion, which is now the second highest debt category after mortgages. In fact, people have taken out so much money just to buy a car that auto debt has increased 70% in the last decade. So to compensate for that, people are forced to take out longer loans just to stretch out their payment to a manageable level. Or in other words, instead of taking out a $30,000 loan for 4 years, pre-pandemic, which equates to $690 a month, they're now taking out a $50,000 loan for 8 years. So this way their monthly payment stays relatively the same, even though behind the scenes this results in more debt, more interest and less equity. However, we now have another aspect that could completely flip the car market from where we are today, and this is something you gotta pay close attention to. Alright, now in terms of the car market, there are 2 main points that you need to be made aware of, especially if you're going to be buying or selling in the next year. With the first being rising inventory. See, here's the car inventory is often measured in what's called days supply, which calculates how many days it would take to sell off current inventory. At the current sales rate, at the worst of the shortage, most brands were under 30 days, with some of the more popular models literally selling the moment they hit the lot. But today we're back to about 70 days worth of supply, which reflects a perfectly balanced and normal market. But not all brands are created equal. For example, Dodge currently sits at 111 days worth of supply. Ford has 99 and Lincoln has 127 days, reflecting a lot of unsold inventory and plenty of discounts. On the other hand, Toyota, Honda and Subaru are still in high demand, with certain models under 40 days worth of supply. So the prices throughout these automakers are staying pretty firm. This has resulted in some very clear winners and losers throughout the auto industry. And if you're wondering where prices are rising or falling the most, you're going to want to hear this. Surprisingly, the largest increase was seen throughout the BMW 4 Series, up nearly 20% year-over-year in the used car market. Why? Well, it's theorized that this is the result of limited supply combined with high demand for luxury cars in that price point. This is also the same thing being found the Infiniti QX60, which is up 16.5% from a year ago, and the Porsche 718, which is up 15.7%. On the other hand, the largest decrease was from none other than Tesla, with prices falling double digits over the last year and depreciating 70 times faster than a Chevy. Now, a lot of this is likely due to the fact that Elon Musk has come pretty polarizing lately. Electric vehicle tech is changing so quickly that some buyers are just waiting for the latest innovations, and a lot of people who wanted an EV have already bought one. But if you're in the market for a used EV right now, I got to admit, it's pretty tempting to pick up a good deal for a fraction of the price new. And if you bought a Tesla between 2021 and 3 for full price, oh well, you probably lost about 50 to 70% value in the last 24 months. Unfortunately, although keep in mind this is only one component of the overall market, and even though inventory is increasing, there is another curveball coming pretty soon, and that would be tariffs. That's right, in an unusual turn of events, automakers are preparing for a 25% tariff on imported vehicles and parts, meaning once again, prices could go higher. For instance, analysts estimate the tariffs will add around $3,000 to the cost of US-built cars and a whopping $6,000 to vehicles made in Mexico or Canada. Not to mention Porsche is holding on to extra inventory, not sure how much to mark up prices to compensate for the extra cost. Now, if you're wondering why on earth prices of US-built cars like Ford would see a price increase, keep in mind most vehicle manufacturers cannot feasibly source all of their parts from the United States, and it's common practice to import various materials from around the world. This is why no matter what car you buy, there will be an impact to its price if tariffs remain in effect. On top of that, there's also talk that automakers might actually just stop making lower-priced cars altogether if they just aren't profitable anymore. And if certain parts get too expensive or hard to find, we could see even more production delays. So even though the car market was finally starting to cool off and head back to normal because of tariffs, we could see prices starting to go back up again, with one estimate suggesting that each car might cost $2,000 more than it did previously. But in terms of where prices are realistically headed over the next year, and what you could do to save yourself as much money as possible, here's what you came for overall. It seems like most experts believe that used car prices will continue to see a gradual downtrend over the next year, especially if defaults increase and inventories stay high. Some forecast even suggests that new car prices could fall a few percent as competition heats up, but there's also a chance that prolonged tariffs erase this decrease entirely and actually cause new cars to get more expensive, leading to more demand for used cars. For example, we're already starting to see this throughout older vehicles, and as CarEdge pointed out, retail customers that want to purchase a car sub $20,000 are forced to look at older, used vehicles because the new ones have increased in value beyond their budget. That's why if you're in the market for a car, I highly recommend you take your time. You're not afraid to negotiate, and most importantly, if you're getting a loan, shop the loan around to find the best possible deal. That way you're not going to be reliant on the dealership, who's going to charge you whatever they could get away with. Typically, I found that credit unions offer the best deal, and there are plenty of ways that you could save a ton of money just by doing this yourself, ahead of time. Separate from that, in terms of what you could afford, the general rule of thumb is what's called the 2,410 rule, which suggests you make a 20% down payment on a 4-year loan, where you spend no more than 10% of your monthly income on transportation. If you could follow that, you're going to be in a great position financially, even though in reality the opposite of that happens, unfortunately. The average down payment is just 11.7% on a 72-month loan, with a car that's kept for just 71.4 months. So basically, people haven't even finished making their payments before they roll it into a new loan to start the process over again, with negative equity that needs to stop. Thanks so much for watching, and until next time.